The Institutional Investor Hall of Famer, known to move markets, is bracing for a sharp market pullback. Marko Kolanovic is JPMorgan's chief market strategist and co-head of global research. Welcome back, Marko.
Hall of Fame.
Thank you.
Nice.
Hall of Famer, yeah.
Beautiful.
Thanks,
Perhaps multiple times, in fact.
He deserves it.
Marko, you, like so many people, started the year very bearish on stocks. You stuck with it pretty much. It's been not an easy ride, but at this point in time, you do see the pain coming.
No, so we had the price target 4,200, and sort of, in fairness, we thought that this is going to be a more volatile year, that we'll see more sort of chop. Instead, we got that summer rally, primarily driven by tech, which was sort of very painful. When that market came down sort of to our price target, and we remain somewhat negative still, so not necessarily calling for immediate sharp pullback, but we do think that recession will eventually happen. So sort of upside versus downside stocks is not that great.
But this gets at the conversation we were just having in terms of timing. You can be an investor who believes that recession will hit, that there will be some sort of a landing, some sort of a recession, and that the pullback will come. But it's hard to position yourself at this point in time because I don't know, the job market's still strong.
Job market is still strong, but you are starting to see stress in consumer. If you look at the sort of the delinquencies in the cards, in the auto loans, and basically, inflation is there, and rates are higher for longer. So this thing will eventually come, right? And so then we look at sort of upside versus downside, right? And could there be another 5, 6, 7% upside in equities? Of course, right? But if there is a downside, it could be 20% downside, right? And now you compare that to the cash, 5.5%. So now how much equity upside above 5.5%? So maybe 3, 4%. But then downside 20%, right? So that's that equity. Timing is very hard, right? And this year particularly, and we didn't get it timing good. That said, we still stick to that. It's not attractive. It's not exciting. There is an alternative. And recession, I'm not sure how we're going to avoid it if we stay at these level of interest rates.
Mel, what do they call it when a video goes viral?
A viral video.
So
Viral.
It's crazy.
Yeah.
Well, I mentioned that because Rick Santelli was here the other day.
Yes.
And his call
13%
went viral. I mean, 1.5 million views now. You probably saw that. What are your?
I did see.
I don't think you think rates are going there, but what are your thoughts on rates? Here we are at 4.7% at 10 years.
So it's pretty high, right? And then when you compare the multiple of call it these top 7, right? Or in general multiple of Nasdaq or S&P, it just doesn't add up, right? Historically, this level of rates doesn't add up with the multiple PE. In the cycle we are, right? The other thing is what's going to happen, right? So rates could actually go a little bit higher. I think the 13% might be, things would probably break a lot sooner than that happens. So I don't think it goes that high, but could go up a little bit more, which is already, I think, problematic for the multiple.
So, Marko, there's been 2 markets. There's the Nasdaq and, the Magnificent 7, whatever you want to call them. And then there's the rest, which have been flat or down? Right. Do you think that it is possible to just have a recovery out of those into others?
So that's a very good point, right? So Russell is down 2% for the year, right? The cash is up 5.5%, right? So S&P equal weight is down, right? The top Magnificent 7 up a lot, right? So 2 course of action. If you don't believe that there is a recession, I guess buy those, right? Buy the ones which are lagging, right? Recession doesn't happen, they will lead, right? But don't buy these magnificent, right? If there is a recession, I think magnificent one catch up or catch down to where the rest is. So whether you want to take a sort of view on recession, there is also relative value component. So some things got beaten up already. Tim mentioned sort of staples, utilities, and those type of things. Some of the cyclicals.
So, Marko, part of what I think's got you into the Hall of Fame in the strategist world is also you have a quant kind of approach and a quant background, and a lot of the I just feel like the market we've had has something to do with positioning, and it's had something to do where sentiment is, and it just seems to me that that's been part of the story. In hindsight, that's always easy to say, but where are we now on that stuff? Because I remember your call in March of 2020, excuse me, with COVID, and you were just like, "This is crazy. This is a screaming buy." Sentiment feels awful when just 6 weeks ago people were, I think, over their skis.
Yeah. No, that's a very good point. So positioning does matter a lot, and it did matter this year as well. So we started November, December with very low positioning, tech, pretty much everything. Volatility was still high. And then volatility was coming down pretty consistently this year. As volatility comes down, many of these technical investors like vol targeters, CTs, they all little by little sort of increase. So that was a tailwind, right? So you had that big tailwind, I think underestimated by the market. And then you had the sort of tech AI thesis. So that sort of got us to the highs in early this summer. But now volatility is picking up. VIX is not anymore 12, 13. Now it's like 18, 19. And sort of data are also becoming a little bit more shaky. So we are now where we now like we are now around, we call it around 50th, 60th percentile. So it's not very high positioning. It's much higher than it was in December. In December was maybe 10. 10 out of 100. Now it's like 50 out.
That doesn't sound very bullish. It sounds to me like, in other words, all this sentiment hasn't really done much to positioning, and actually, people aren't that long. No,
it's a sort of middle, like about average. I would say means can go up or down positioning wise. But we do think that the sort of this cycle part is going to get tougher and tougher. So as the consumer erodes savings and cash.
Marko, thanks so much for your time. So I remember the quant report that you used to put out, being that Tim just brought it up. You used to put it out with Scott and Amin and a few other people. How should investors be thinking about volatility as an asset class right now? I know we're always talking about should we overlay or buy outright optionality, but in terms of actual allocation, can you touch on that a little bit?
Yeah. So it's hard to own just volatility because there's always negative carry to it. Volatility is a protection, so you need to pay for it. It was also tough this year, but it got this summer when it got to 12. In July, it did look really much. You need to own some of the downside protection. Investors are also selling short-term options, 1, 2, 3 day options. They're overwriting some of the ETFs. So it's been used also to generate as an asset class to generate yield, generate carry. But so now at 18, I think it's probably still good to own some of it, but not as attractive when it was down to 12 or 13. So.